In this module, we're going to discuss prepayment risk and mortgage pass-throughs. Prepayment risk is a particular type of risk that mortgage-backed securities are exposed to. Prepayment risk refers to the ability of homeowners to prepay their mortgages. So mortgage holders or homeowners often have an option to prepay their mortgage early, and that creates prepayment risk for investors in mortgage-backed securities. We're also going to discuss mortgage pass-through securities. A mortgage pass-through is the simplest example of a mortgage-backed security, and so we're going to spend some time as well on this module, discussing pass-throughs. Many mortgage holders in the US are allowed to prepay the mortgage principal earlier than scheduled. Payments made in excess of the scheduled payments are called prepayments. Now, there are many possible reasons for prepayments. Number one, homeowners must prepay the entire mortgage when they sell their home. And there are many reasons why somebody might need to sell their home. Maybe they're moving for a new job, maybe they're getting divorced, and so on. Homeowners can also refinance their mortgage at a better interest rate. So, for example, suppose a homeowner took out a mortgage when the interest rates were very high on mortgages, and maybe 5 or 6 years later they'd see that interest rates are much lower. Well, the ability to prepay allows the homeowner to prepay their mortgage and then take out a new mortgage at a much lower level of interest. A third reason is that homeowners may simply default on their mortgage payments. Maybe they're behind in their payments, they can't catch up, and they simply default. In this case, if the mortgage is insured, then the insurer will prepay the mortgage as well. And finally, for another example, the home might be destroyed by floods or fire or some other catastrophe. Again, insurance proceeds in this case would prepay the mortgage. So there are many possible reasons for prepayments. The second reason we've highlighted here is a very valuable reason. It's the prepayment option that mortgage holders have. In particular, they can benefit when interest rates go lower. And so this is a prepayment option, and like all options, it has a positive value to the owner of the option. In this case, the US homeowner typically. So prepayment modeling is therefore an important feature of pricing mortgage-backed securities, and the value of some mortgage-backed securities is extremely dependent on prepayment behavior. Again, we'll come to some examples of mortgage-backed securities in later modules. For now, we're going to consider the simplest type of mortgage-backed security, and that is the mortgage pass-through. Now, before I go on, I should mention that pretty much everything I'm going to be saying here is very US-centric. The mortgage markets, or the market for mortgage-backed securities, originated in the US in the 1980s, and that's where most of the modeling and, if you like, action in the mortgage markets has taken place. So I'm going to be focusing mainly on the US, but that's fine because pretty much everything I say will apply in some form or another to mortgage markets generally. Also, the bigger picture that I want to get at here is the general idea of securitization and how mortgage-backed securities and indeed asset-backed securities can be created. How are mortgage pass-throughs constructed? Well, in practice, mortgages are often sold on to third parties who can then pool these mortgages together to create mortgage-backed securities. In the US, the third parties are either government-sponsored agencies such as Ginnie Mae, Freddie Mac or Fannie Mae, or other non-agency third parties such as commercial banks. Mortgage-backed securities that are issued by the government-sponsored agencies are guaranteed against default. That is not true of agency mortgage-backed securities. What do I mean by default here? Well, what I mean by default here is just that the homeowner might default on their mortgage payments. They just may not make their mortgage payments and therefore the mortgage can go into default. Well, in that situation, if the mortgage-backed security was issued by Fannie Mae or Freddie Mac, for example, then the agency will step in and guarantee the payments. This is not true in general of non-agency mortgage-backed securities. So the modeling of mortgage-backed securities therefore depends on whether they are agency or non-agency mortgage-backed securities. The simplest type of MBS is the pass-through MBS, where a group of mortgages are pooled together. Investors in this MBS receive monthly payments representing the interest and principal payments of the underlying mortgages. So here's a diagram explaining how this works. We saw this before in the last module. We've got 10,000 mortgages. Of course, the number doesn't have to be 10,000. It could be 5,000 or 20,000 mortgages. We've got mortgage number 1, mortgage number 2, up to mortgage number 10,000. All of these mortgages are pooled together into one mortgage pool. And from that mortgage pool, we can create new securities. These new securities are mortgage-backed securities, and maybe they've got names like Tranche A, Tranche B, down to Tranche D and Tranche E, and so on. For now, let's not worry about these tranches. In fact, in the case of a mortgage pass-through security, we don't have any tranches, but we will see some examples later on where you can have tranches. So these 10,000 mortgages form the collateral for the mortgage-backed security. And so when we create these new securities out of the underlying pool of 10,000 mortgages, this process is often called securitization. And as mentioned earlier, the economic reasons for securitization is the desire of people to spread risk. Most people, most agents, most investors do not like risk. They need to be compensated for holding risky securities. So one could view these 10,000 mortgages individually as being very risky. If you hold any one of these mortgages, there will be a substantial chance that the homeowner will default, for example, or prepay. And so there'll be risk associated with these mortgages. But by pooling them together, creating new securities, we can sell these new securities on to investors who want a particular type of risk. And so that is the economic or financial motivation behind securitization. The pass-through coupon rate, and we're referring now to our mortgage pass-through, is strictly less than the average coupon rate of the underlying mortgages. And this is due to fees associated with servicing the mortgages. Somebody has to collect the mortgage payments every month and do the bookwork and bookkeeping to make sure that the homeowners are up to date on their payments and so on. We're going to assume that our mortgage-backed securities are agency issued and are therefore default free. Now, I'm going to give you a couple of definitions here. You'll find when we discuss mortgage-backed securities that there are many definitions. The weighted average coupon rate, WAC, is a weighted average of the coupon rates in the mortgage pool with weights equal to the mortgage amounts still outstanding. Similarly, the weighted average maturity is a weighted average of the remaining months to maturity of each mortgage in the mortgage pool with weights equal to the mortgage amounts still outstanding. Now, there's no need to worry about the specific details of these definitions. I just want to mention that there are many definitions associated with mortgage-backed securities. We also need to discuss some important prepayment conventions that are often used by market participants when quoting yields and prices of mortgage-backed securities. But first, we need some definitions. One definition is the following. The conditional prepayment rate, the CPR, is the annual rate at which a given mortgage pool prepays. It is expressed as a percentage of the current outstanding principal level in the underlying pool. So this is the so-called conditional prepayment rate. A very related definition is the single month mortality rate, the SMM. The SMM is the CPR converted to a monthly rate assuming monthly compounding. And so therefore the SMM and CPR are related as follows. Now the CPR is expressed as an annual rate, and so it is probably the rate that makes most sense to us. We like to think in terms of annual rates. We think of interest rates expressed as annual rates. And so likewise, we might think of a conditional prepayment rate as an annual rate. However, when modeling the payments of a mortgage-backed security, we typically need the corresponding monthly rate. And that's because payments in mortgage-backed securities typically take place monthly, and so we want to be able to convert our CPR to the SMM. And that's what we do here. We will also see how the SMM and CPR are used in the spreadsheet that is associated with these modules to calculate the various cash flows underlying the mortgage pass-through and indeed other mortgage-backed securities. In practice, of course, the CPR is stochastic, it is random, and it depends on the mortgage pool and other economic variables. We saw, for example, earlier that prepayments tend to go up when interest rates go down, and that's because it is more attractive to homeowners to prepay their entire mortgage and then refinance at a better rate, which is possible when interest rates have gone down. So the prepayment rate for a given mortgage pool will certainly depend on the economic variables that are present at any given time. And that having been said, market participants, that is, people who work with mortgage-backed securities in the marketplace, they often use a deterministic prepayment schedule as a mechanism to quote mortgage-backed security yields and so-called option-adjusted spreads. Now, we're not going to discuss option-adjusted spreads at all in this course. That's fine, so you don't have to worry about what they are. The standard benchmark is what is called the Public Securities Association benchmark, or the PSA benchmark. The PSA assumes the CPR is equal to 6% times T over 30 if T is less than or equal to 30. And I should mention here that C is now measured in months here. And then after 30 months, CPR is equal to 6%. So the assumption here is that the conditional prepayment rate of a mortgage is 60% if it's more than 30 months old. If it's less than 30 months old, the conditional prepayment rate is 6% times T over 30. So basically the CPR grows linearly for 30 months and then it's flat. So this is time T in months, this is 6%, and this is the CPR. And then slower or faster prepayment rates are then given as some percentage or multiple of PSA. So for example, 2 times CPA refers to a mortgage pool that repays at twice this rate. A 50% CPR refers to a mortgage pool where the conditional prepayment is half of this CPR. Given a particular prepayment assumption, the average life of a mortgage-backed security is given as the following. So it's equal to the sum from K equals 1 to capital T, K times PK divided by 12 times TP, where PK is the principal, scheduled and projected prepayment paid at time K, TP is the total principal amount, capital T is the total number of months, and we also divide by 12 so that average life is measured in years. It should be clear that the average life decreases as the PSA speed increases. And that makes sense because if the PSA speed increases, well then you're going to get more of your principal payments earlier in the life of the mortgage. So the PKs for K small will actually be larger when the PSA speed increases. And so average life gives you a measure of the average life, or how long you have to wait to get the payments associated with a mortgage or mortgage pool. Implicit in the calculation of the average life is some assumption regarding the speed of prepayments. In practice, the price of a given mortgage-backed security is observed in the marketplace, and from this a corresponding yield to maturity can be determined. This yield is the interest rate that will make the present value of the expected cash flows equal to the market price. So if you recall what a yield to maturity is in the case of a fixed income bond where the cash flows are fixed, well, it'll be some quantity that satisfies the following. So it will be NI equals 1 CI over 1 plus lambda to the power of I. Now, if the payments are made semi-annually and we're compounding semi-annually, then I should divide lambda by 2 here and multiply the I by 2. But basically, lambda is the quantity that makes this equation correct, where P0 is the value of the fixed income security in the marketplace, and CI is the cash flow that you receive at time I when you own this fixed income security. The problem with mortgages on mortgage-backed securities is that the CIs are uncertain. You don't know what they're going to be, and that is because of prepayments. So when you are calculating a lambda or a yield to maturity for mortgage-backed security, you have to fix the CIs. And the way to fix the CIs is to make some assumption about prepayments. And so that's what market participants do. So the expected cash flows are determined or based on some underlying prepayment assumptions such as 100 PSA, 300 PSA, etc. So any quoted yield must be with respect to some prepayment assumptions. When the yield is quoted as an annual rate based on semi-annual compounding, it is often called a bond equivalent yield. Yields actually are very limited when it comes to evaluating a mortgage-backed security and indeed fixed income securities in general. They don't take account the term structure of interest rates. They don't take the prepayment option into account. So yields are very limited, and indeed the marketplace typically uses option-adjusted spreads as the market standard for quoting yields in mortgage-backed securities, and indeed other fixed income securities with embedded options. But as I mentioned before, we're not going to be discussing option-adjusted spreads, so there's no need to worry about that in this course. An investor in a mortgage-backed security pass-through is of course exposed to interest rate risk, in that the present value of any fixed set of cash flows decreases as interest rates increase. However, pass-through investors are also exposed to prepayment risk, in particular contraction risk and extension risk. When interest rates decline, prepayments tend to increase, and the additional prepaid principal can only be invested at lower interest rates. So this is contraction risk. So if you think about it, when interest rates fall, if you own a home and therefore have a mortgage, it is in your interest to prepay that mortgage early and then refinance the mortgage at a much lower level of interest. If you do that, then the people who have invested in these mortgage-backed securities, they're going to get payments sooner than they expected, and these payments can only be invested at the lower interest rates. So this is called contraction risk. The opposite also provides a risk, which is called extension risk. In this case, when interest rates increase, the prepayments tend to decrease, and that makes sense. After all, why would I want to prepay a mortgage early when I'm going to have to refinance it at higher interest rates? So therefore, interest rates increase implies prepayments tend to decrease, and therefore I'm getting less prepaid principal than I expected, and so I'm not going to invest that principal, that prepaid principal, at the higher interest rates that might now be prevailing. This is called extension risk. So, to summarize, in addition to the regular interest rate risk that fixed income securities have, mortgage-backed securities and mortgage pass-throughs are also exposed to prepayment risk, in particular contraction risk and extension risk.